If you're a short-term rental host with a W-2 income, there's a really good chance that you are overpaying on your income taxes because you're probably not taking advantage of what I consider to be the greatest tax loophole of our lifetime, aka the short-term rental tax loophole. And here's the thing, it's going away every single year, little by little, so it behooves you to take advantage of this right now, before it's gone. Like, forever. In this video, we're gonna be covering depreciation, bonus depreciation, and how cost segregation studies work, which I know sounds like a lot, but please do your best to get to the very end of the video because we do a very good job of breaking this down step by step in little baby steps to help you grasp the wonderful, wonderful concept of the short-term rental loophole. And I promise it'll all make sense by the end of the video if you just hang with us for a bit. To really make this whole concept crystal clear, I brought in CPA Mitchell Baldridge, who is also my business partner over at strcostseg.com. Together, we have collectively lowered my community's tax bill by millions and millions of dollars. And last little thing here before we hop in, there's one little PDF here that you're gonna need. It's called the 7 Rules of Material Participation. It's free and you're gonna need it as a reference for when the video is over, okay? Let's stop paying taxes. The reason I brought Mitchell on specifically today is because I've got a student, her name is Carly, who just made an offer on a property, and if this offer works out, which it's looking pretty good, she's gonna put down $0 because it's a creative finance property. Yeah, it's pretty nuts. And it's a $550,000 home and zero money out of pocket. And she will reduce her taxes by $30,000 as a result. Now, I don't want to open up the can of creative finance in this episode. I've got a case study in the description down below if you want to learn how that works. What I really want to talk about today is how people can use the short-term rental loophole to their advantage to lower their taxes every single year.
Watch that case study after this video, get all the way through here. And going back to the very beginning, I mean, real estate is probably the most tax efficient business in the world. Everyone knows that real estate guys, they all make a bunch of money and they pay no tax. Is this true?
This is very, very true. Yeah.
So
it seems too good to be true, but this is actually something that happens.
So the Airbnb loophole kind of like brings this idea of real estate tax savings through leverage back to the common proletariat, the good hard worker out there.
Let's hop into Depreciation 101. Just break down the basics of how real estate sort of works for investors.
Totally. So, let's talk about depreciation as a concept. It's the idea that you buy a piece of equipment or a capital asset that the cost has to be recovered over time. You could buy a stapler or a pen, a telephone or a microphone.
Okay.
At below $2,500, and you just get to write the thing off as far as the government sees it. I mean, yes, this microphone will last years. It's great, but the government just says, you know what? This is a $700 thing. Write it off. When you go buy a building, you can't just write it off. You can't just deduct it in the first year. A building's supposed to last a pretty long time. And so the government gives these kind of arbitrary schedules, but it's a 40-year piece of property that gets to be deducted 2.5% a year over the, until it goes to zero.
So let's break that down a little bit. So if I buy this microphone,
yep.
I guess let's assume it's pivotal to my real estate business. I could write off $700, meaning that if I made $1,000 that year, it actually now looks like I made $300 because I wrote off the $700 microphone.
That's right.
And so as a result, it looks like you made $700 less, meaning I'm going to pay less in taxes.
Yeah, and like with a microphone or with a stapler or a pack of pens, you did make $700 less. You earned $1,000. Sure. You spent $700 on some equipment that was ordinary and necessary and essential to your business. You get to write that off. But when you get into a pickup truck or a tractor or a office building, although that's an ordinary and necessary expense, the cost has to be recovered over time. So that's the concept of depreciation.
So let's just break that down even further. Let's say I make $200,000 a year and I buy a $200,000 house. I can't write off $200,000 from that house.
Yeah, and to be clear, like you can never write off your personal residence. This is
all
about
like an investment property.
This is all about investments, and this is all about running a business. But if you bought houses are 27 and a half years. So if you bought a $275,000 house, you would be able to deduct $10,000 a year over the next 27 and a half years. So if you made $200,000, base case, if you do no planning like we're about to do, you'd be able to take the 200 and mark off 10,000, and you'd be left with 190.
Got it. And then now I pay taxes on 190, not 200.
That's right.
Cool. And that's typically how it works for most real estate investors?
Yeah. So, residential versus kind of office, industrial, commercial properties have different tax lives. The residentials are at 27 and a half year, and the commercials at 39. Real estate folks go buy a building and they get a bunch of rents and they pay taxes and insurance and they pay their mortgage, and they don't get to write off their mortgage principal. They do get to write off the interest payments, and this depreciation expense at the end is kind of a phantom expense, right? Like, it's not dollars out of your bank account, but depreciation is real. Your building is degrading over time.
Over time, you will have to replace things.
You will have to fix the driveway. You will have to replace the roof one day. The hot water heater is going to blow up.
And one interesting thing about short-term rentals, it is actually not a 27 and a half year lifespan. It is now a 39 year lifespan. So how does that work?
We'll get more into that, but the idea of a short-term rental is not a house. It's a hotel. Right. So if you rent your property for less than 7 days, this is even though it looks like a house and smells like a house and someone can come live in it as a house, as you own it, as you've been operating it, it is a hotel. It is a commercial building.
You sound like all my Karen neighbors.
Yeah, exactly. Oh, no. Yeah,
I didn't want a hotel next to my house.
This is the zoning board. Yeah. So going back to kind of depreciation, then, we're saying, okay, now it's a $390,000 house and you're going to be able to deduct it over 39 years and it's $10,000 a year, right? Well, there's another layer of nuance, which is it is not a house. It is a constructed group of a bunch of pieces of things. So there's a sidewalk, there's a driveway, there's a garage, there's a roof, appliances, plugs, windows. And so, like, what we do at STR Cost Seg is we run an engineering study to break this home into all of its component pieces, to say, hey, here's a 1,800 square foot house, but it is not one house that's 39-year property. It is ceiling fans. It is accessory electrical plugs. There's a hot tub in the back. There's a pickleball court, and we break it into all of the different components to apply shorter lives to a lot of these pieces of the property.
And these shorter lives, is it 5, 7, and 15?
Yeah,
years?
5,
Okay.
7, 15, and then 39. And so the benefit of identifying and carving out and calling out these 5, 7, and 15-year properties is that, one, you can just deduct them faster. It doesn't take 39 years to deduct 5-year property. You get to take it over 5 years. But then, two, you get to bring in the funnest type of depreciation, bonus depreciation. And so bonus depreciation is this concept that's kind of been brought out and phased out and brought back and phased back out over the last 25 years in the U.S. tax code. The government prints the money anyway. They don't need the taxes, right? And so the taxes are sort of this idea that they get to incentivize people to take certain actions.
Yeah.
And so when the economy slows down, when the economy slowed down in 2001 after 9/11, in 2008 in the Great Financial Crisis, and even going into COVID, the government creates these stimulus measures, one of which is bonus depreciation. They can say, look, you taxpayer, we want you to go spend money, and we want you to go buy capital assets. We want you to buy a Ford F-150.
They're basically rewarding the boosting of the economy, right? So
yeah.
That's why we often say that the real estate tax code, or that the tax code is written for real estate investors.
Bingo, because somebody has to build and maintain all of these capital assets around us, trillions and trillions of dollars of assets. The government's not organized enough to do it and doesn't have enough money, and we're supposed to go do it as business people. So now bonus depreciation comes out, and in 2017 with the Tax Cuts Jobs Act, it was the biggest bonus depreciation boondoggle there ever was, because it allowed bonus depreciation on used property, which had never happened before. So you could buy an Airbnb bungalow built in 1938
I see.
And go carve up the sidewalk that was poured in 1974
and
rebonus it again. Yeah.
Okay. So how does that actually come to a head Because basically with depreciation, we're getting that 1/39th. I think you said that 2.5%. When you get into this bonus depreciation world and you've actually like broken out these components with the cost seg report, what does that actually look like when it reflects on your taxes? Are you now getting to write off all of that in the first year?
Yeah, so like let's talk about Carly's house that she's buying for $550, right? So like there's these I call them like levers of bonus. Or, you know, there are these 5 ways to like kind of run your property through a filter to decide, is this going to be a property that gives me a lot of bonus depreciation, which is 30, 40, all the way up to kind of 100%? Or is this going to be a low property that's going to give me like 10% bonus depreciation, right?
There's 5 levers, and then we've actually got 2 bonus ones as well.
Yeah.
So
bonus.
Can you run us through quickly, and we'll break down each lever, but just recap what the 5 are really fast, and then let's hop into each one. And then I want to really break down, Carly's buying this house. So how the heck is she actually lowering her tax bill by $30,000 as a result?
Yeah, let's talk about them all. So the 5 are land, the percentage of this $550,000 property that Carly bought, what is land and what is actually improvements built on top of the land. The second is, once you get into the improvements, what percentage of the improvements are these shorter life assets versus what are longer life assets. The third is leverage, meaning like how much money are you putting down?
Right, how much are you borrowing?
Versus how much are you borrowing. And in this case, Carly's borrowing 100% of it, so that's going to be great for Carly, hopefully.
Good for you, Carly.
Yeah. And then the fourth is effectively what is Carly's tax rate? Is she paying 12% taxes, or is she in the highest tax bracket living in New York paying 52%? The fifth is, what is the current bonus depreciation percentage out there? So today it's 60%,
but it used to be 100%.
Yeah, so from 2017 to 2022 it was 100%, meaning all the 5-year property you placed into service, you could deduct it year one like a stapler. In 2023 it went down to 80. In 24 it's down to 60. It's supposed to go down to 40 20 and then to 0.
But maybe it'll come back.
We can go like light a candle in your backyard or something right after this podcast, but probably not before the election in November of 2024.
Probably not, yeah.
Nothing's going to happen. But a lot of talk about bringing it back for a lot of reasons. Whole other pod.
Yeah, okay.
We'll get all into it.
We'll do that one next.
Yeah.
Okay, so let's break down.
Click right there.
Land. Yeah, when it's out, we'll hover it up here. Okay, so let's talk about land.
I could be a YouTuber.
Hey, you're doing it.
Yeah.
Man. Tell people to like and subscribe.
Yeah, like and subscribe.
Yeah, thank you. Actually, get a little closer. We got to get you in the right this way.
Oh yeah,
there we go. Okay, cool.
Yeah, like and subscribe.
Perfect. Okay, so let's break down land. Yeah, that's the first lever. What does that actually mean?
So land means, look, Carly's buying a $550,000 house. She's buying it all in. She's buying everything that comes with it, everything that detracts from it. She's buying the stinky neighbor behind the back with the Airstream trailers all piled up or whatever. So land is a component of a home purchase. On the tax rolls, they tell you what is the land and what is the improvement and what is the total value.
And if I understand that correctly, it's because you can't actually depreciate land because land is just a thing that exists and will always exist.
Hopefully, yes. We're banking on land always existing, and so the
another pod.
the IRS does not allow you to deduct land or depreciate land or recover your costs in the land, because presumably you could always tear down the property and
rebuild something else,
build something new. So you said Carly's property in particular, like she's paying $550, and the land is
at max, I don't know, 20 to 50,000.
So we're call it 50.
Yeah, it's in Arizona. Of that $500,000 purchase, I would say $500,000 of it is going to be the improvement value, which is what she can actually depreciate.
But if she had bought that same property in Costa Mesa, California, whatever, in some,
it would be flipped.
It would be flipped. It would be a literal shack that like is almost taking away value from the land because the city won't let her tear it down, and it would be $500,000 of land that is impeded by the structure on it. And so that's a huge component of, are you buying a property in New York where all the value is in the land, or are you buying on cheap land and buying a lot of improvements? And so then, the second lever is when you get the 50 of land on the side and just know you're never going to deduct that.
How much of your $500,000 property can you break down in bonus?
Yes. And so, we're talking mostly about Airbnbs, but like the thing about Airbnbs are like would be a lot of them have a lot of 1245 property because they have a lot of amenities. They'll have outdoor furnishings and outdoor improvements that are all generally 1245 property. They'll have hot tubs, they'll have saunas, they'll have all of this stuff out there, and they're all kind of built up. Whereas if you look at different property types, like example of property with the least amount of 1245 property would be like an industrial building that just is
like walls and like not even drywall.
Yeah, it's like foundation, slab, steel beams, roof,
corrugated siding,
a few lights that just provide enough light to literally light the building so you don't fall over when you walk in. Like those will have like less than 10% 1245 property.
So Airbnbs just have a lot of write-offable things.
Yeah, and a lot of variants. But
sure.
But a lot of them, they'll get 20 to 40% somewhere in there of that $500,000. Say 30% of that will be 1245 property. So she'll have $150,000 out there of 1245 property. The best example of property that has the most 1245 property, gas stations. Oddly enough, there's some law out there that the big gas lobby got through that, like even those big Buc-ee's are all 1245 property.
Like everything.
The entire Walmart size building, all of the pavement, all of the asphalt, all of the electrical, all the everything is just write-offable day one.
So let me ask this, because I want to sort of give, it's a rule of thumb-ish, but it's not particularly accurate. But basically, the rule of thumb that I've heard whenever you're trying to figure out how much you can sort of allot towards like the depreciation on this is you take your improvement value and you multiply it by 20 to 30%.
Yep.
And that's about how much 1245 property
Yeah,
is.
call it 25, or like in this example, we're calling it 30. We're just saying she's going to be able to take that $500,000 structure and write off 150.
Okay, and that would equate to 30%.
Yeah, we're just assuming that this one's 30%, that she's going to be able to deduct $150,000, and that's reasonable. Maybe a little aggressive, may not be aggressive enough. We've seen you get 40 before. We've seen you get 25 before.
A property has, the Scottsdale property lowered our taxes by...
That was a monster.
$600,000. So that was pretty good. So that kind of brings us into, I guess, tax rate.
Yeah.
Because tax rate on that $150,000, this is where it really starts to kind of come together.
Yeah. So the third lever is tax rate. And so if you have no other income out there and this is you're paying no tax already and you stack a bunch of losses on top of it, I mean, you can carry them forward, but it's not going to help you in the immediate term versus, if you're doing Airbnb full time and your spouse is a endodontist and makes $750,000 a year and you're in the highest tax bracket, these losses are going to help you a lot. So it really depends on what your situation is, if you're in a high income year or a low income year, if you pay a lot of tax or if you don't, because this is going to be limited. These are losses that then get kind of pushed down by your marginal rate. And so if you're in a high tax bracket, they're going to help you a lot. If you're in a very, very low tax bracket, they're not going to help you as much.
Got it. Yeah. So what's interesting about that is, and we'll talk about this probably a little bit towards the end of the video, but if she's materially participating in the management of the short-term rental, meaning she's running the operations, right. There's a few tests here. We'll get to that in a little bit. She can basically take that $150,000 deduction and it carries over into her W-2 income.
Yeah. And not to get too far into this, but real estate income by its nature is passive income. And so the losses by their nature are passive. So if I just write a real estate syndicator a $100,000 check and they return me $40,000 of loss year one, I can't really use that to go deduct it against my business income. But with this Airbnb, you're really running a hotel. Remember what Karen told us?
All right, Karen. All right.
And so you are running a business where the property is incidental to the business. Sure. So as long as you're materially participating in the business, then you can go ahead and
can cross over.
Yeah, and watch out for excess business loss rules. Zooming all the way back, hey, you are in the deep end of taxes, people.
Oh yeah.
Call your accountant. Yeah. Call your priest.
You are a CPA, but you are not their CPA.
That's right.
And I am not. go get your qualified tax help.
Take this to the very front. But so you are in like layer 3 of kind of tax planning, and you want a professional along your side, because if you make assumptions based on what you think is going to happen from a tax standpoint, and you go buy a house, and then what you thought was going to have happen doesn't happen, you're a putz. Yeah.
So go call a Baldridge CPA, and they'll get you taken care of. So, okay, let's go back to tax rate, which I think is important here. So let's just say in this case, her tax rate is 32%.
Yeah, the tax rate is meaningful, because if she's at a 32% tax bracket, we're not in 100% bonus, but let's just say she gets 100% bonus on this 150 out there. 150 times 30 is 45. So she would get like a $45,000 reduction in her tax bill,
which is a salary for a lot of people.
That's
now,
a monster.
I will also say this, because you're talking about and this is actually one of the levers, the bonus percentage. This is why I wanted to make this video, because if you bought a property from 2017 to 2022 and you haven't gotten a cost seg done, you can still do that. And you would get 100% in those moments.
Yeah, and then we don't have to amend your tax returns. You can file this form called the 3115 and deduct that kind of catch-up depreciation in the current year.
So I know we just said that quickly, but that's the most important thing for anyone here that has purchased a short-term rental in the last, from 2017 to 2022. If you did that and you haven't gotten a cost seg, you have to. Okay, you don't have to.
I always say, if you're running a short-term rental and you're washing poo-poo sheets or whatever you're doing, and you're not getting the tax benefits of a short-term rental, you're crazy. You're missing out, because this is the best part of running. I'm a tax guy, so I would think this.
Yeah, we need to get you in the game. So, okay, so that's 2017 to 2022. You can actually go back and you can claim that 100%. Now, 2023. If she bought this last year, she could have gotten 80% of that 145.
She could have gotten 80% of the 150K deduction, or 80% of the $45,000 tax savings.
Correct. And then this year it's 60%.
Yeah.
So now she's getting 60%.
So it's a 90K deduction, and it's
30% of that, 30 grand.
30 grand tax savings.
Which is why we're saying in this instance that she's going to lower her taxes by $30,000.
We've done a lot of public math, which is risky.
So that's why bonus percentage is also another lever, because depending on when you bought it, which year, is going to factor into how much tax deduction or reduction you can have.
The last lever that we forgot about was leverage. We forgot about it in Kaylee's scenario because she's just 100% leverage, so it's easy.
Yeah.
But
basically, she's seller financing the property outright from the owners and just making payments to the owners.
She basically said, "Hey, I'm going to pick up your payment, and I'm going to take this thing off your hands, and I'm going to make sure that the bank gets paid."
Yeah. She's that's right. She's taking over payments, and then she's seller financing the equity. Zero money out of pocket. Again, we won't open. I know a lot of people are like, "Wait a minute, what did you just say?" Watch the case study in my description down below. It kind of breaks down how creative finance works, and it'll make more sense. But in this instance, she's not going to the bank, she's not putting any money down, and as a result she's kind of taking this cash flowing property that will lower her taxes by 30 grand.
Look, Airbnbs and houses in general are great. If I'm talking about industrial property versus gas stations and kind of how much 1245 they have, Airbnbs are very attractive in that you can still get high leverage. I mean, the real estate market's a mess out there. If you want to go buy industrial property, you're probably going to get 50, maybe 60% leverage. I mean, as rates are moving around, there's people who just aren't even writing term sheets right now, But home ownership is America, right? And so banks and the government and Fannie Mae and Freddie Mac and the VA are all set up for folks to get inexpensive home financing. And so today housing rates they're 7%, which sounds awful, but in the grand scheme of things, that's sort of normal,
in line with historical numbers.
You could still go take 20% down and buy a home in a conventional mortgage scenario
and still get a huge tax break. It just compounds with creative finance, basically.
But you can probably still go buy homes with, you can go buy FHA houses with 3.5% down. I mean, you got to live in them. But,
you got to live in them. But in a year, this is what we call the sneaky rental strategy. You just basically convert it into a rental and then do it again.
Sneaky rental.
Yeah, it's legal, isn't it? It's called sneaky because it's a sneaky way to build a portfolio.
You don't have to tell me.
No, I swear. It's by the book.
It's fine, dude. Okay. It's whatever.
Blink once if I need help. Okay. All right. So those are the 5 levers, and then we've got 2 more little bonus guys.
Yeah.
We've got the cost ratio. How much does it cost to get this done?
So back to STR cost seg. Like you're handing us money to build
Ding.
this engineering. Yeah. We're creating an engineering report that you can go hand to your accountant, that you can get this money back from the government. You can go borrow this money from the government interest free. We'll talk about that in a second.
That's a good
But
one.
ultimately, all that matters is what you pay us to prepare this report and what you save in the end. So that's one of the levers, is that STR cost seg frankly does a fantastic job. I mean, I own the company, you own the company, so we're a little bit biased.
Yeah, but it's really good because can we say do we say how much does it cost? We can say it starts at? Yeah, okay. I'm going to say this because whether you choose to use this or not, like, I don't care. I just want you to go and save the money. I would prefer that you do, because our reports start at like $8.95 and go from there.
Yeah.
So in this instance, Carly would go to STR cost seg, put in her info. We would produce a report that's quality.
Data-driven, engineer-reviewed.
There you go. Engineer review. That's the word I was looking for. And it's $8.95, and she, as a result, hands that to her CPA. CPA enters and does all the beep, boop, boop, boop.
Yep.
And taxes for her will go down $30,000.
Yeah, come to our website, type in your address. We'll give you a proposal of kind of a conservative versus optimistic view of what we think you're going to save out there, and before you even pay us a dime, and then we'll tell you what it's going to cost, and we'll give you your kind of like savings ratio up front. So ultimately, this is a lever, because if you're getting a 30-to-1 payback versus if you're getting a 4-to-1 payback, it's meaningful in whether you decide to do a study and
$1,000
strategy.
Lower taxes by $30,000. Easiest investment on the planet.
Money printing button.
Okay, last one.
The last lever today is, and we used to not even talk about this until the last couple of years, is like, okay, so there's this concept of recapture. I call it Newton's law of tax. Like what goes down must come back up. So
meaning it's not a free lunch, basically.
There are no free lunches in tax or nature unless you die. We'll talk about that in a second. But
I love it. That's a great foreshadowing.
Yeah. You don't need
lunch. That's how this video ends. We die.
Yeah, we all die. So there's a concept called recapture. Kayla's put nothing down. She's taken a $30,000 tax boondoggle. You know, she's taken $150,000 of the property and just deducted it in very, very short order. What happens is there's this concept of basis. Like when she paid the money for the property, she got tax basis in the property. Everything she's doing to like recoup the costs through depreciation into that property is lowering her basis. So when she goes to sell that property, she's going to have to recapture all these deductions she took. And so there's some planning around how to sell it. You can use a concept called a 1031 exchange, where you roll over your basis and go buy another property
and defer and kick that can further down the line.
Yep.
Yeah.
But ultimately, you're creating, in accounting terms, a deferred tax liability. So
that's what we mean by reducing your taxes.
So you're taking all of the expenses that you were going to take over the next 39 years, and you're front loading as much as you possibly can to this moment right now. So this is not an infinite money button. You can't buy a property, take the deduction, go sell it, buy the next one, take the deduction, go sell it.
Can't get that clever. It's like when people buy a car and they're like, oh, I'm going to write it off and then sell it in a year. And it's like, well, you got to pay it back. And the recapture tax is not small.
I had a client once, a new client meeting, and the guy had like 6 trucks in the back of his office, and he's like, yeah, those are my trucks. That's how I save taxes. I'm like, bro.
But you're paying $500 a month on each still.
Yes. Yeah. So ultimately, though, the lever in this is that we've accepted this is a loan from the government. You are front-loading deductions today to reduce taxes today, but this is an interest-free loan from the government. Like, you don't have to go pay. It's a deferred tax liability. It's more debt. It's a liability, right?
Let me break down that a little bit. So basically what we're saying is, instead of paying the taxes today, Carly could not take bonus depreciation. She could just do this the regular way and pay $30,000 $2,000,
Yeah.
whatever it works out to, more in taxes today. Or she can say, I'm going to use this cost segregation report, take advantage of bonus depreciation, not pay the $32,000 today. I'm going to keep it aside if I want to.
Yeah.
And I'm going to put it in a 5% high interest savings account for the next 10 years until I sell the property. And then at that point, the taxes would be due, but at least she made 5% on that money.
Or she's just going to buy crypto and just make a zillion.
You can do whatever
right?
you want with it. That's the best part.
So
like
long as you
save
have
the
it
money,
when you need to go pay it back.
You lower the money. You lower the reduction. You don't save because, again, it's not a free lunch. You lower your taxes, and whatever you want to do with that $30,000, you can use it to invest. Again, she can now use that to go put money down on the next property and so forth and so forth.
This is, I will pay you Tuesday for a hamburger today.
Yeah.
Dude,
I mean, this is why it's so powerful, though, because let's just say she decides to keep it for 15 years and she has to pay back in 15 years. Regardless, the money that she's paying back to the government at that time is going to be way less valuable due to inflation than it is today.
Yeah. So, I mean, ultimately, we can only project forward the next 40 years in some ways as how the last 40 years has been. And this has been a winning strategy to date. The only way you can get ahead of yourself is, again, if you take the $30,000 of savings and you go buy a jet ski and then it washes off into the ocean and you don't have the money when you go to sell the property and the property hasn't appreciated enough where all of the recapture just kind of doesn't matter because you made so much money on the property that you're feeling great. You can get yourself in trouble. This is leverage. This is debt in its own way, so you have to manage it.
You still have to be smart. It's not just like, woo, well, thanks for this 30 grand, government. I'm gonna go, and it's actually 2 jet skis.
Bingo.
You can never have one.
What does a jet ski run you? You know, how many jet skis do you have?
None, dude. It is my biggest dream in life to own one, and I know it's so silly. I know I love jet skis. I really do.
So with all that being said, I mean, ultimately, real estate professionals run this strategy over and over because the goal of monopoly is to get as many properties as you can on the board and not go bankrupt. And so this is a tool in your belt to kind of increase leverage, but it just has to be used responsibly.
So here's the interesting thing. He just said real estate professionals. Real estate professionals are able to take advantage of this. And real estate professionals are people that work 750 hours a year in real estate, and it has to make up more than half their time. So you cannot work a full-time W-2 job. You can't be a doctor and a real estate professional at the same time.
There was just a tax court case where this exact situation happened, and the guy was like, yeah, but I own all this property, and the tax court was just like, sir, you're a doctor, like you have a full-time job, we're not going to say you're working 40 hours here and 41 there. They didn't even test the time or anything.
Really?
They just basically said it's impossible.
You can't double dip.
So we've put that to bed. But
so that's okay. So that's interesting though, right? Because most of the time to take advantage of this, you have to be a real estate professional. Where this video is gonna sort of end here is a couple of things. Is it kind of changes once you become a short-term rental host. And you materially participate in the management of your short-term rental. You basically self-manage it. There's 7 ways to do this. As a matter of fact, we've got this PDF right here that outlines those 7 ways. It's linked in the description down below. Download that. It's going to be the most important resource for you. Sift through it. But if you materially participate in the management of it, you don't have to become a real estate professional. You can actually take advantage of bonus depreciation and cost segregation studies as a W-2 employee. And that's where you really start unlocking wealth. So if you need a cost segregation report, again, go to strcostseg.com. But if you're a visual learner and you want to learn what material participation entails, and you want the short-term rental loophole explained to you in excruciating detail, watch this video right here. Ding.